We are going to be diving deeper into these deals and also the impact on the auto industry with Autolist Editor-in-Chief David Underkoffler. That's at 9:40 a.m. Eastern Time later on this hour, so stay tuned for that. Well, it's not often a Fed rate decision is just one of the big events of the week. Well, the FOMC unlikely to alter policy at its meeting on Wednesday, but it is likely to be overshadowed by the Treasury Department's fresh borrowing plans, which could impact an already volatile bond market. Earnings from Apple are the big corporate release of the week and will be viewed as a possible tailwind for stocks, with the S&P 500 now mired in a technical correction. Joining us now, we want to bring in Cameron Dawson, NewEdge Wealth Chief Investment Officer. Cameron, lots to unpack here this morning, but let's start with where we start the week here. Just ahead of the trading day, we have the S&P entering correction territory last week. We also saw that from the NASDAQ. How does this set us up? And I guess, is this a signal maybe of more weakness that's still ahead?
Yeah, we did get oversold into the end of last week, so that does support some kind of bounce over the short term. We seem to be seeing that this morning, but I think that the challenge that we're in now, which is that we got oversold back in August, we got oversold back at the beginning of October, and each of the bounces that followed those conditions were pretty tepid. So what's resulted is that now we can see sort of a short-term pattern of lower highs and lower lows for this market. And it means that a lot of the areas that were support for the market, things that we hoped that the market would be able to bounce off of, have now somewhat become resistant. So a lot to go on this week. I think in the very near term, you are oversold enough to have some kind of relief rally, but then let's judge that relief rally to see if it sets us up for a move higher or if we'll continue in this downtrend.
Yeah, and this is typically the time of year where we get into that larger thinking, that question of, will we see a Santa Claus rally come December? Is that off the table at this point in time from your perspective?
No, because seasonality is supportive at this point. But I think the important point here is that you'd be starting from a lower level. When a lot of people were hoping for a seasonal rally, you were at higher levels for the S&P, which had people projecting us getting back up to those July highs by the end of the year. Now that we're starting from a lower base, it just is a much higher bar to get you back up to those July levels. And yes, you could see a rally, but that doesn't necessarily mean that we go back to the kind of powerful up into the right market that we really had all from April through July until we entered this more volatile period.
Cameron, let's talk about the Treasury Department bond sale that's coming out here on Wednesday. Some out there on the street saying that it's actually a bigger event than the decision that we're going to get from the Fed on Wednesday. Just talk to us just about the significance of this and what the reaction could potentially be across the broader markets.
Certainly, it is very important because we think that we've been living in a world of big supply and demand factors for the bond market, which is why you have seen this lift higher in yields rather abruptly, meaning that you have seen increased supply. But the real key component here is that demand has been weaker for bonds. Part of that is the Fed itself. So we don't want to completely downplay the Fed's role in the lift in yields. The Fed has gone from being a huge buyer of bonds in the QE era to now being not buying bonds in the quantitative tightening era. They've had their balance sheet pulled down by nearly $1 trillion. That has contributed to this lift in yields. And so now we're in this scenario where we're really having to judge, will the Fed be willing to come in and buy bonds if economic weakness does materialize sometime in 2024? But until then, as the Treasury steps up supply, that means lower prices for bonds, higher yields in the short term.
Speaking of some of the Fed considerations and the calculus coming forward this week, what do you believe that they're going to be watching for, especially coming out of the jobs data on Friday, to really give them the inclination going into their November meeting about where that decision should rest, or at least where the tenor of the conversation should move forward, especially considering that we've been having the higher for longer considerations tossed about, or at least evaluated by the market right now?
Yeah, it is a really important point because if you go back to Powell's comments from a couple weeks ago, instead of talking about how tighter financial conditions, those higher bond yields could drive the market toward the economy to slow down because of that tightening in financial conditions. Instead, he focused on just how tight the labor market is and how strong demand is, and that could be the justification for them needing to do more. Our view has been that the Fed is going to be resistant to cut rates as long as the labor market remains tight, simply because they would be afraid that inflation could come back if they ease policy into a tight labor market and a tight economy. And so I think that the challenge that the Fed will have is that they have this tightening in financial conditions, and yet the near-term data, the current data, still says very strong economy, very tight labor market, which does not give them any wiggle room to ease policy or talk dovish.
So, Cameron, let's talk about what all this means then from an investment perspective. Certainly, people are out there trying to figure out how they should best position themselves for the remainder of the year, and then, of course, looking ahead to 2024. So what are some of the adjustments that you've made most recently as we have seen a bit more weakness creep into the market?
Certainly, we're finding opportunities in pockets of the market that have been getting sold off hard or really are trading at cheaper valuations. If you look at the equal weight S&P 500, in the near term, technically, it's in a downtrend. It's only about 5% off of its October lows. At the same time, it's only about one turn of multiple off of those October lows. That overall index is still struggling, but what I think it identifies is that there's a lot of great companies in there that are high quality, that have good balance sheets, strong free cash flow, that you can find that are trading at discounted multiples and are somewhat near their October lows. Then if we think overall, we have to remain very focused on quality in this market. We do think that we are late cycle, which just means that the balance sheet is incredibly important, meaning that we have to watch very closely about companies' interest costs, how much debt they have coming due, what they'll be rolling that debt over in this higher for longer environment, which means selectivity is highly, highly key, and really focusing on that balance sheet, I think, will be the big determinant between winners and losers in this environment.
Cameron, I know we've been talking end-of-year rally and Santa Claus rallies, but move over, Elf on the Shelf. I'm peeping the Ninja Turtles on the shelf behind you there. Shout out to that. Just giving me another idea for Halloween tomorrow. All right, so I'll have to figure out how to pull that off with some homemade pizzazz to it. Cameron Dawson, NewEdge Wealth Chief Investment Officer. Thanks for taking the time.
Thank you so much.